Hi, I'm Greg Corombos. My guest at this time is Brian Wesbury, Chief Economist at First Trust Advisors in Wheaton, Illinois. He's also the former Chief Economist for the Joint Economic Committee of Congress. He joins us now to discuss the latest devastating job losses, the plunge and partial rebound in the oil markets, and the concerns of some that trillions in additional government spending will result in inflation at a very inopportune time. So a lot to get to in just a few minutes here. And Brian, thanks very much for being with us.
Hey, Greg, as always, it's great to be with you.
Well, more than 4.4 million jobs lost in the past week, and in the past 5 weeks, over 26 million jobs lost. So is it even possible to explain what the toll of that, in addition to all the lost productivity and revenues, is on our economy in the past month and change?
Yeah, it is really difficult, Greg. These numbers that we're gonna see in the next few weeks and months are ugly, ugly, ugly. The unemployment rate is probably already 15%. It could climb over 20%. GDP in the second quarter will be down 20 to 30%. These are Great Depression-like numbers. And I would like to explain a little bit about how far this goes, because we're now seeing states and municipalities who are the ones that actually shut down the businesses that pay for what they do, complaining that they don't have enough money and they want more money from the federal government. We also see that in the restaurant industry, for example, we are euthanizing chickens because there's no place for those eggs to go. There are two kind of supply chains, if you will, one that goes to restaurants and hotels and caterers, and one that goes to grocery stores. The grocery stores are fine. It's the restaurants that are shut down. And so anybody that is supplying business to them is getting hurt. They're literally killing chickens, and it will take time for all of that to get back. So you can't just turn off the U.S. economy and then turn it back on. And people that think that you can are just simply wrong. It's going to take us a while once we open to get back to normal. And I know that people won't want to fly and sit next to each other in stadiums, et cetera. But I think eventually we will get back to normal. It happened after 9/11, and I think it will happen here. But the damage that's been done to the economy is immense.
Brian, what's your analysis on the impact of the PPP, the Paycheck Protection Program? Earlier this week, when the Treasury Secretary, Steve Mnuchin, was explaining that they were close to a deal, and as of this recording, they seem to have the deal done. Right. He said it saved 30 million jobs just in that first 350 billion or whatever it was, and now they're obviously expanding that. So how big of an impact has that program had?
Yeah, it's really hard to tell right now, Greg. I mean, so we have, in a sense, two competing forces going on. One, we're lending money to small businesses to pay their rent, their utilities, and to bring their employees back. But at the same time, we've given extremely generous unemployment benefits too. Now, by the way, I do worry about the expansion in the size of government, and I know we'll talk about that in a minute. But if you're going to take someone's job away, force a business to close, in the Constitution, that's the Fifth Amendment, it's called a taking, and then you have to give just compensation for that. And so in a way, we have no choice. If this is the way we're going to go, then the government is going to have to spend this. But these two forces are competing. For example, in Texas, over the next 4 months, a worker on unemployment benefits can get the equivalent of $58,000 a year. Now, it's not for a full year, but for the next 4 months, for many workers, it pays to be on unemployment insurance rather than going back to work. So we actually don't know how many people companies are going to be able to bring back, because some of them may just say, no, I'll see you in 4 months. And so it's way too early to say how many jobs were saved. And if you look at initial unemployment claims so far, it's impossible to say any were saved, because as you have already mentioned, we've seen 26.5 million people file for unemployment benefits in the last 5 weeks. And that says we keep growing unemployment. It's hard for me to imagine that unemployment would have gone to 50% without PPP. But only time will tell. If we actually see workers called back, then we should see those initial unemployment claims number go down. But it's too early to tell whether that number that he threw out is actually what's going to happen.
Brian, as you know, most Americans have probably thought of this lockdown, for lack of a better phrase, to last first 15 days and now through the end of April. And depending on the state, it could go longer than that. But even long term, you've got folks like Dr. Fauci saying, look, mass gatherings, sporting events, concerts, what have you, we might not have fans for those even as far into the fall. You've got some school districts already talking about not being sure whether they can start on time in the fall. And you've even got the CDC already telling people this winter, the coronavirus could be worse than it is right now. So how aggressive of a re-engagement can we have when we're already seeing all these dark clouds on the horizon?
Yeah, Greg, that is a question that is kind of up in the air. And by the way, just the threat of that kind of thing happening, or that the government reacts to pandemic models the same way in the future, is going to change the whole country forever. Businesses will hold more cash. People will be more cautious. There will be less risk taking because if you invest in something and then you're forced to close, you lose. And it had nothing to do with you're a bad business person or your competitors were better than you thought. It's because the government shuts you down. And so let me just take this opportunity. You know, it's kind of interesting if you look at the pandemic models that all of these doctors use. And in fact, there's not Dr. Birx and Dr. Fauci, I am not saying that they want a pandemic. No one does. Please don't hear me as saying that. But they've been training all their lives to prepare for one. And so whenever they see something like that, they start putting numbers in their models. And if these were perfect models, then you would expect them to guesstimate too high half the time and too low half the time. But when we go back and look over history, they're almost always 97, 98, 99% of the time, they guesstimate way too high. That's the initial estimate of 2.2 million people dying. And that's because we just lack the data, and they're working with these models that actually explode. And it turns out that it's never that bad. And so sometimes giving the experts control over the economy and they don't understand the economy can actually lead to disaster. I am seriously worried that there will be more people die in the long run because we shut down the economy. We have destroyed $2 or $3 trillion worth of actual GDP. Plus, we've boosted the debt on us, on our children, on our grandchildren by $4 trillion at least. And so what we have done is we have permanently hurt the U.S. economy, which will damage our growth in the future, our ability to invest in healthcare, and the health of individuals that don't have jobs. And we know that recessions lead to worse health.
And of course, we've got a lot of folks with other health issues being forced to take a back seat right now, not necessarily getting treatment on schedule and having to postpone other things, which has already led to a lot of folks seeing heart attacks and strokes and so forth, among other ailments, not nearly at the same numbers as normal. And we're pretty sure people didn't just stop having coronaries just because there's a coronavirus concern right now. So we don't know the toll here. But let's talk about a couple other issues we have in our remaining time here, Brian. And one of those is inflation. We are already on track to have $1 trillion deficit in this fiscal year. And now, of course, with the over $2 trillion spent on the CARES Act, and now we've got another roughly $500 billion in this latest legislation. Who knows what's still to come? There's folks saying $4, maybe $5 trillion of deficits just this year on top of everything else. And some folks are wondering whether that's going to bring on a ton of inflation. I know there were worries a few years back that quantitative easing would do that. It didn't seem to. So are the concerns justified or not in your mind?
Yeah, this is a great question, Greg, and not you're everything you listed is perfect. We're also going to lose $500-600 billion of revenue, and that's how we get to a $4 to $5 trillion deficit. All the spending plus the loss in tax receipts. And that's going to happen at the state and local level too. And then what's happened is that the Federal Reserve has come in and bought a lot of those bonds. They've printed money to pay for those. And the money supply today, we're in a different situation. After 2008 with quantitative easing, the Fed bought a lot of bonds, but it didn't really turn into an increase in lending, a massive increase, or in the money supply. But today, lending is up about 100% year over, or in the last 3 months at an annual rate. The money supply is growing close to 40% at an annual rate, and that's what creates inflation. However, on the other side of that, because now people are going to be worried that at any day the government could shut things down, they're going to want to hold more cash. So in economics, if you can kind of think of it that way, we print a lot more money, but if people hold more cash, that offsets some of the inflationary impact. And so the way I'm looking at this is that we're not going to have deflation. It's true that gas prices have come down, airfares, hotel rooms. I mean, we've seen a lot of things fall in price, but over time, because we've increased the money supply, this isn't going to last. Other things have increased in price. For example, eggs and toilet paper, some food items. And so the bottom line is I expect inflation to still be here next year and then likely rise in the future. But we will just have to wait and see how businesses respond to the potential to be shut down at any point in time. And so that's the thing. It's a battle between all the new money flooding into the system and then businesses and individuals willing to hold that money as cash, because that means it doesn't turn into inflation as quickly as some people might fear.
Last topic, and we're talking with Brian Wesbury, former chief economist at the Joint Economic Committee for Congress, now chief economist at First Trust Advisors in Wheaton, Illinois. And Brian, just in the last week, we obviously saw a tremendous fluctuation and essentially a giant plunge in oil futures. At least for May, they went down, I think, as far as minus $40 a barrel. So they were paying folks to hang on to it. It looks a little more stable for June and July. And just in the past couple of days here, the prices have looked a little more sturdy. So what's your analysis of that? Is that a quick shock to the market with all this pent up supply and not much demand, or is there real concerns there long term?
It's a little bit of both. I look at that crash in oil prices. If we remember the flash crash in stocks, the market went down 1,000 points in less than an hour one day. And then it basically recovered very, very, very quickly, just like oil did. And part of it was trading problems. So what it turns out is that there are many futures trading platforms where people will trade futures that could not accept a negative number. And so as a result, once we went negative, all of a sudden liquidity in that market dried up. And I think that's why we had the massive volatility that day. The bid for oil was actually minus $100 a barrel, even though it settled at minus 37.5 that day. But having said that, this kind of volatility isn't a shock, especially you shut down the economy like we have. Gasoline demand in the U.S. is 50% lower today than it was a year ago. And we know what Saudi Arabia and Russia just did. They both increased production. So far, now we're slowing down fracking in the U.S., but the U.S. was producing record amounts of oil. And so we flooded the whole system. We couldn't even, there's hardly any place left to store oil. A lot of it is sitting in ships today. And so right now we need to get the economy open, begin to see gasoline and energy demand increase. And that's why these prices have stabilized, because that's happening slowly. It's going to take a while, but I think by the third and fourth quarter, we're going to see things get not all the way back to normal, but we're going to see the demand for energy begin to increase, storage capacity to begin to empty out a little bit. And at the same time, we're closing wells in the U.S. The Saudis and the Russians are both cutting back production. So that's why I do not expect to see the negative numbers on a barrel of oil price again in at least in the near term.
Brian, thanks very much for being here. We appreciate it.
Thank you very much, Greg. Great to be with you.
Thank you, sir. Brian Wesbury, Chief Economist at First Trust Advisors in Wheaton, Illinois, former Chief Economist for the Joint Economic Committee of Congress. I'm Greg Corombos reporting for Radio America.